Welcome everyone to the Navigating the Post-COVID Economy webinar. Thank you all so much for joining us. As you have questions, you may post them in the Zoom Q&A function and we will answer your questions at the end of the call. We will try our best to answer all of your questions at the end of the presentation, but if for whatever reason we are unable to get to your question today, please email learning@nfp.com. At this time, I'd like to introduce Tom Leonard, Managing Director of Trade Credit at NFP. It is my great pleasure to hand over the call to our speaker. Tom, the floor is yours. You're muted, Tom.
Thank you all for joining us for navigating Canada's post-pandemic economy. I think we're all excited to see, we're starting to see the light at the end of the tunnel, but with the different challenges that are coming with the economy, we're hoping to give you some insights in what these challenges will be and how to deal with some of them. We're going to start by having one of the leading trade credit insurance underwriters, North American economist, Ruben Nazard, talk about the economy. We're then going to have the leading bank in Canada, National Bank, Manager of International Trade, Chris Bennett, and Director of Commercial Banking, Blair Dixon, talk about the banking sector insights and working capital solutions to go with that. And then I'm going to talk a little bit more about some specific trade credit risks and some solutions. So we're going to start with Nazard. That'll be about 20 minutes. National Bank will be about 10 minutes and I'll be about 10 minutes. So hopefully we'll wrap this up in 30 or 40 minutes and then we can move on to some questions. So I will pass the baton over to you, Nazard.
Good afternoon, everybody. Thank you for joining us today. Thank you to NFP for putting this event together. I'm really happy to be joining today. So today I'll be talking about our COFAS economic outlook for the world, with a focus on the North American market and more specifically the US, taken as an example of the challenges that we're currently seeing in this recovery environment from the crisis triggered by the COVID-19 pandemic. So this is what we will be discussing today, and I'll be happy to take your questions at the end of the presentation, as mentioned by Tom just a minute ago. So just to start, a quick word on the pandemic, because while it might feel in some part of the world that it might be something of the past, the virus is still here and still circulating, especially in emerging markets. And when we're talking about the economy and this recovery environment, we still have to factor in this issue of the pandemic, with the threat of new variant resistant to the vaccine still over our head. And also, we know that with vaccine hesitancy still high in some advanced economy, we're seeing rise in new cases, which are triggering some hurdles to the recovery. Most recently, we've seen in the US and in Canada, some drop in business and consumer confidence associated with the rise in COVID-19 infections linked to the Delta variant. So that's one example of how this virus continue to affect the global economy. But so far in 2021, and it's probably going to continue through the end of the year and in 2022, what we've seen is a big divergence between the countries which have access to the vaccine and those we have not. So on the one hand, we've seen advanced economy, which had access to the vaccine quite early on, and which were able to fast track the process, especially in North America, the US and Canada being the first countries to actually authorize the use of the vaccine. But it has been slower to get through to emerging markets. And you can see on the previous slide that Brazil, India, Russia are all lagging in terms of vaccination rates, exposing them to the threat of these new waves of COVID-19 infections, new waves of restrictions. And we've seen this example quite recently in many Asian economies, which were quite interestingly quite insulated to some of the first waves of the pandemic, but we've seen, for instance, in India being forced to go back into lockdown. We've seen Taiwan, which was spared by the crisis last year, which was one of the few countries to be spared by the crisis last year, being forced to go into lockdown as a result of this new wave of infection. So we still have to factor that in. Looking more specifically at advanced economies and North America. So as I mentioned, because they had access early to the vaccine, they were able to reopen their economies faster than most economies. And it's been especially true in the US. And you can see on the left-hand side chart with this blue line that the US is one of the first country and the first G7 country to return to its pre-COVID-19 levels of activity. So this is quite a significant step taken by the US. You can see with other G7 countries that the recovery, especially since Q3, has been slower because they have been struggling with new wave of infection in some cases. So you can see, for instance, that in Q1, Germany's GDP contracted again as a result of new restrictions being implemented. It's been the case in Canada in the second quarter with stringent restriction through most of the quarter, and it's been a key factor behind the slight decline in GDP that was experienced by Canada in the second quarter of 2021. But as the vaccination progressed in these countries, we expect that the reopening process will be able to move forward, and that these countries will return to their pre-COVID-19 level of activity by the end of 2021 or very early in 2022. The other reason why we've seen the US lead this recovery is also because of the scale of policy support. And it's been also one of the key reasons why we've seen so many divergence in the recovery between countries so far in the second half of 2020 and in the first half of 2021. So the US has put more than 25% of GDP in terms of fiscal response to respond to the COVID-19 pandemic. And many of this response took the form of stimulus. And it has been a key factor helping the recovery. But it's far above the average in most advanced economy, where the average fiscal response was about 15% of GDP. And that's why you can already see why it's a key factor in why the US was able to recover faster. This is also true with emerging markets, which are lagging this recovery, where we've seen less fiscal space to respond to the crisis, and where the average was below this 10%, below 10%. And as a result, they are still far below their pre-COVID level of activity in most cases. I think that it's quite easy to illustrate the boost received from fiscal stimulus by looking at consumption patterns in the US and how it affected consumption patterns, which is a key driver of growth in most advanced economies, and in the US in particular, accounting for about 2/3 of GDP. And you can see that every time there's been one of these famous stimulus checks being sent to households and authorized by the CARES Act, approved in March of 2020, approved by the Consolidated Appropriations Act at the end of 2020, and by the American Rescue Plan in March this year, you can see that there's been a bump in consumption and in expenditure by households. I think another key and interesting aspect of this right-hand side chart is that you can see that the recovery has been particularly true for consumption of goods, and that consumption of goods has been faster to recover to its pre-COVID-19 levels of activity, while consumption on services has been lagging, which is no surprise. And this is a pattern that we've seen in most economies so far, is that services are lagging because there's still the threat of the virus. In some cases, there are still some restriction. Some people still fear that they can catch the virus. So they are lagging because they don't feel comfortable yet returning to restaurants and mostly traveling. So it's been a key trend. And this recovery in goods consumption, on the other hand, is quite interesting because this surge in consumption goods has been a boon for industries which were affected quite heavily by a drop in demand in the spring of 2020, and since then there's been a surge in demand, most specifically for consumer goods. But the flip side of this recovery in demand for consumer goods is that it has created a mismatch in demand and supply. We've seen a very rapid rise in goods consumption, as I mentioned, in the US, but it's been also the case in China, two of the key markets. And we've seen also consumption recover quite fast for goods in Europe, in European economies. And it has created some delays and supply chain disruptions. And you can see, for instance, with this left-hand side chart, that it has created a huge lead times for production materials, and the time to get inputs has increased to record levels. So this level of 91 days from order to actual delivery is actually a record in this survey conducted by the Institute for Supply Management in the United States. And that's a pattern that we've seen all over the world. And it's now a key constraint to the recovery. And actually, it's quite strange, because in the span of 18 months, we've been through a shock of demand, and the main concern was on the demand side because of restrictions constraining demand for goods. And now we're back in a position where, despite the recovery, we're seeing this recovery be facing headwinds as a result of headwinds on the supply side. And they're not only because of this mismatch between supply and demand, but more and more markets are also reporting labor shortages. It's been the case, again, with taking the example of the United States. But you can see here with this graph that when you look at the ratio of unemployed per job opening, it dipped below 1 in 2021 and in the last few months. And these signals that for the first time that there are more job openings available than unemployed people. And it suggests tightness on the labor market, and it could be a constraint on the recovery. So the reasons are still being debated, but it seems that many questions about post-pandemic work arrangements are playing a role here, with more people willing to reassess what they want for their job. And it's again, it's not only something that we've seen in the US, but also in Europe and in most OECD countries, actually, and including Canada. So it's quite interesting because it happens quite early in the process, while the recovery on the labor market in most economies doesn't seem to be complete. So taking again the example of the US, the level of employment is still about 3.5% below the pre-pandemic level. So that it just tells you that it's been a kind of a puzzle. We're still having more unemployed people that we had prior to the crisis, and yet businesses are reporting labor shortages constraining their activity. But it's also interesting to note that these labor shortages and this constraint of labor supply are mostly concentrated in services sectors as of now, and less so in goods producing sectors. Another consequence of these supply demand mismatch has been the impact on prices. Because we have a mismatch between supply and demand, we've seen a very high increase and a surge in most prices for inputs and for commodities. So that's what you can see on the left-hand side with these indices tracking the main families of commodities. And you can see that since the second half of 2020, basically, we've seen most categories and almost all categories of commodities surge to multi-year highs. So it's been the case of agricultural commodities, of base metal commodities, with higher demand for steel, for instance, in the construction sector. In for agricultural commodities, we've seen higher demand for lumber. And it's been part of the issue and part of the reasons why we've seen this rise in prices, because at the same time, many businesses were struggling to keep up with this very high surge in demand that we've seen with the example of the US earlier, and that it's caused a surge in prices. To that, there's also been some shocks. There's also been some one-off shocks on some commodities. So, for example, a few weeks ago, the wheat and hard wheat were in the media because droughts this summer in major wheat exporters in North America, the US and Canada, but also in Eastern Europe with Russia and Ukraine experienced droughts. So it also caused wheat to reach multi-year high. Last week, it was aluminum, which reached a decade high after a coup attempt in Guinea, which is a key producer of bauxite. So we're seeing these kind of tensions on commodities prices, and what it means is higher prices for input for businesses, which is a concern because it will probably erode margins in the future. The good news is that in the second half, in the last quarter and in 2022, we should see these tensions on the supply chain ease a little bit and ease gradually. So if there's any price increase, it will probably slow. We've actually seen some commodities prices decline. So I mentioned steel and lumber, which had increased quite fast in between January of 2021 and May of 2021. But this summer, especially, they've experienced a decline, and maybe there's most commodities will follow that pattern going forward. These pressure on prices are also reflected on the surge in freight rates because of a surge in demand for containers for ships. Freight rates have surged to unprecedented levels, and again, it's putting pressure on prices. And that's also one of the reasons why we've talked so much about inflation this summer, and why the topic of inflation seems to be back on everybody's mind, and why the Federal Reserve might have to act in the future, why the ECB might have to act in the future. And we'll see in a minute that emerging markets have actually already had to act to respond to higher inflation levels. So these supply side chain issues have affected one sector in particular, and it's been all over the news. It's the automotive sector. You can see here that most specifically the shortage of semiconductor of chips, which are key to the manufacture of new vehicles, has been impacting quite hard the automotive sector and all over the world, including in North America. And you can see that output loss associated with output loss of automotive associated with the semiconductor shortage amounts to accumulated 5 million vehicles approximately so far this year. So that's quite significant. And in North America, we can see it constraining growth already. I've mentioned a bit earlier that Canada GDP declined slightly in the second quarter of 2021. One of the key reasons behind that is that trade of automotive vehicles and auto parts has slowed quite dramatically compared to Q1 because of the supply chain disruption associated with the semiconductors. I think what also interesting thing to see is that it is impacting sales as well, because the production of new vehicles is being impacted. What we've seen is that the inventory of vehicles has declined quite substantially, and so as a result, sales of new vehicles has slowed in the U.S. and what we've seen is that we've seen more and more people going to buy used cars and trucks because they weren't able to find new vehicles in this context of constrained environment. So quite interesting to see that in the case of the automotive sector, with this very heavy supply side pressure that we're seeing, it is impacting also sales and demand for new vehicles. Hopefully the secondhand market has been has been more dynamic in recent years, but the price of second-hand vehicles has been surging quite fast as well in response to this higher demand. So quite interesting to see that example, which is kind of dramatic, but of the automotive sector in this post-pandemic or in this recovery environment. We can see that it is having an impact and that it is creating headwinds to the recovery right now, and it's probably going to remain a key topic throughout 2021 and probably in the first half of 2022 at the very least. So these supply side pressures on the automotive sector is one of the key reasons why COFAS assessment of the automotive sectors remain in high risk. So on a quarterly basis, COFAS assesses 13 industrial sectors based on economic and financial data, as well as using its network of underwriters and experts. And you can see that overall, we've been upgrading most sectors in North America because we've seen some progress in the recovery. Both the US and Canada were among the fastest economy to recover from the initial shock of the COVID-19 pandemic. And with the rise in commodities prices, we've seen positive developments on the agri-food sector in the US, for instance, and that's why we decided to upgrade the sector. We've also seen positive developments in the metal sectors, and the rise in base metals prices is benefiting this industry as a whole. But the automotive sector is one of the few sectors that is still in high risk, and while most other sectors are now in medium risk, in medium risks. Among in high risk or very high risk, we also find retail, textile, clothing, which were among the hardest hit sectors by the COVID-19 pandemic, and which are, as you can imagine, slower to recover. The transport sector, as we can see, with the very slow recovery of air travel and the travel environment being still very constrained, so that's why transport is still in high risk. And the energy sector, because there were some pre-existing challenges associated with the oil sands in Canada and the shale sector in the United States that makes this sector a bit more vulnerable than other sectors in North America, explaining why we have a higher risk assessment for the energy sector than other sectors. So in terms of economic forecast, and as I mentioned, for 2021, we expect quite a strong recovery after we record decline in GDP. You can see that we estimate that it was a global 3.5% contraction in GDP growth in 2020. We expect that world GDP growth will recover to 5.6%. Driven by the US and China. In 2022, we expect GDP growth to slow. So part of it will be a mechanical effect because there will be a lower base effect. As you can imagine, after such a huge contraction in 2020, we were starting from a lower base, so growth rates might seem higher, but we're still expecting quite a high growth rate for 2022. Above the trend that we've experienced over the last decade, meaning that we expect the recovery to continue. More specifically, in some countries, we expect investment to be a key driver of growth, with, for instance, very high investment in infrastructure being currently discussed in the United States, for instance. We'll see what happens with the election in Canada and if it translates into further stimulus, and what is the outcome of the election could affect the outlook for 2022 on that front. So we remain cautious here. In Europe, there's also an investment program sponsored by the European Commission, which will probably support growth. As I mentioned, in emerging markets, the recovery is expected to continue and will probably even gather some pace as vaccine access improves. So that's probably the bright side, but it will probably take some time, and they will probably have to wait until the end of 2022, these emerging markets to return to their pre-COVID-19 level of activity, and even in some cases 2023 or 2024. So looking more specifically at emerging markets, the reason why we're a little bit less optimistic is that they are facing some more hurdles. I mentioned that prices are on the rise and that it's being felt on inflation. And we're seeing that central banks are forced to react to this higher inflation by tightening their monetary policy. So economic policy is less supportive, and it's a further hurdle to growth. So you can see on this right-hand side chart that's, for instance, Russia, Brazil, Mexico have implemented rate rise. Turkey had to react earlier and even in late 2020 because of the very rapid depreciation in the Turkish lira, and this will create some tensions and some slower growth, and will slow the growth momentum. We expect this monetary tightening in emerging markets to continue as the monetary tightening is likely to gain momentum in advanced economies, and that emerging markets will have to follow suit to avoid capital outflows and to avoid a repeat of the taper tantrum of 2013. Canada has already started to tighten its money policy by tapering on its quantitative easing program. The Federal Reserve is likely to do so by the end of 2021 or very early in 2022. The ECB should also make some announcements quite soon, and emerging markets will have to react to that. And in this environment of slow recovery, socioeconomic challenges, but also of health crisis, which is weighing on households' morale, we will think that political risk will be a key theme in emerging markets going forward. On the left-hand side, you can see COFAS Social Risk Index last year has reached a record level, and it's a reflection of the deterioration in socioeconomic indicators, because that's mostly what we look at in our social economic index, looking at socioeconomic pressures, looking at, for instance, inequalities, but also the level of the living standards, unemployment, to measure these socioeconomic pressures. And we're also looking at the tools to express this frustration. And in emerging markets, it's reaching record high, which suggests that we might see some more social unrest. And actually, we believe that some of the events that we've seen in recent weeks are already an examples of what we are likely to see in the future. I'm thinking of recent unrest in South Africa, for instance, and even more recently, what we've seen in Brazil. And that's a pattern that we are likely to see in many emerging markets going forward. So this is with this that I would like to conclude. Just a quick word on our map of country assessment on a quarterly basis. In addition to its sector risk assessment, COFAS assesses 162 countries to try to assess the business default risk. We take into account macroeconomic and financial data. We collect data on the business environment to try to rank countries from A1 to E. At the end of Q2, we decided to upgrade several countries based on two factors. There were countries that we upgraded because they were faster to vaccinate their population and to reopen their economy. So it's been the case for the US and Australia. And we also upgraded some countries which are benefiting from the increase in commodities prices. So I'm thinking, for instance, of Guinea, Saudi Arabia, Russia here. And in some instances where we've upgraded some countries which are benefiting from post-development, like Canada or Mexico. So positive outlook overall to wrap up this session of the economic outlook. Quite a positive outlook, but headwinds are accumulating and growth rates are likely to slow going forward. So that's something that we should keep in mind. The main pressures will come from supply side, and it will probably create some pressure on margins with higher prices. And we should also have in mind that it will prompt tighter monetary policies and lower level of support so than we've experienced over the past 18 months. So these are the key elements of our scenario for the remainder of 2021 and 2022. Thank you for your attention. I will hand over the mic back to Tom.
Okay, thank you, Ruben. We're now going to move on and have national banks talk to us about the bank with some banking sector insight with an international focus and some working capital solutions for Canadian companies.
Okay, hey, thanks a lot, Tom. So everybody, my name's Chris Bennett. I'm a manager of international trade with National Bank. Want to talk to you today briefly about what we're seeing with some of our importer and exporter clients. I'm going to pick up on what Ruben has discussed. So, you know, what a lot of our customers are telling us is that they're seeing strong demand from consumers and businesses in Canada, the US, and also worldwide. So, you know, we can obviously see as a bank, and all the Canadian banks can see that, you know, personal and commercial demand deposit accounts, you know, they're flush with cash. Plenty of consumers have money, plenty of businesses have money, and that has certainly led to an increase in demand for, you know, services and products as well. So once again, strong demand is being seen from a lot of our exporter and importer clients. On the supply chain, I mean, I'm going to really echo a lot of what Ruben has said, but maybe obviously at the, you know, kind of the grassroots level where we're talking about, in this case, National Bank's customer base. But, you know, shipping containers are scarce. So we're hearing that from plenty of our customers and prospects alike. So once again, there's delays of 3 to 4 weeks plus in shipping, and that's leading to a lot of supply chain issues. The cost to ship product is up. As you can see there on the slide, it's up at least 400%. As an example, you know, to ship a container from Shanghai to Vancouver, a 40-foot shipping container typically would cost, you know, in the $3,000 range. Now it's $10,000 to $14,000. So that's really put a strain on and really led to inflation for our customer base. What some of our customers are doing is that, you know, instead of ordering kind of just in time, they're kind of doing a just in case scenario where they're ordering more supplies. So 6 month supplies versus 3 months. We're also seeing, you know, some of our clients use a China plus one strategy. So where they have been typically sourcing from China, they have been in search of an alternative source of supply. So that's something that some of our customers are looking to do and have already implemented in many cases. Exploring manufacturing, you know, in Mexico, so kind of nearshoring versus China. That's certainly a big discussion point with a lot of our customers who export. Also, Canada comes into play a little bit where they're talking about either increasing their manufacturing capability in Canada, or maybe even look at setting that up. So that is something that we've heard from some of our customers as well. Sales are up, profits are down because obviously, as Ruben had alluded to, input costs are really, you know, going through the roof. You know, there's a strong rise in commodity prices, which Ruben had mentioned. I know that in the area that I cover, which is Ontario and Atlantic Canada, we've had a number of folks looking to source aluminum as part of their manufacturing process. And this is going back even 6 months ago. Obviously, you know, from my perspective, I'm able to connect them to a lot of National Bank's customers in Quebec who happen to be in that aluminum manufacturing industry. And in some cases it helped out, but in many cases it's still been very, very difficult to to address the increase in price in aluminum and the scarcity of the product. So a lot of these companies were sourcing the product from maybe China or Taiwan, and they're looking at alternative sources of supply. So really, that's kind of what we're seeing, from, a lot of our exporters and importers across the country. If I'm to discuss very briefly before I pass the puck on to Blair, I'll talk about a couple of the programs that National Bank has that we specialize in that could be interesting for some of the folks on the phone. One would be our supply chain finance program. So that's a program that National Bank has had for over 40 years. And it's a program that's designed to complement, a company's existing operating facilities. And so we have a program on the supplier side, and we also have a program on the buyer side where, these are additional sources of financing to complement their operating facilities. So the company is seeing a rise in growth prospects, and they're seeing a rise in demand. National Bank, has those facilities to I guess address working capital issues and to also address, an extended cash conversion cycle, which most of our customers or most really companies tend to face. So that would be one thing. And once again, we're happy to discuss that with folks offline. Our contact information will be available at the end of the presentation. The second thing very quickly would be our trade finance program. So once again, with companies facing all the issues that Ruben had alluded to, and some of the ones that I had mentioned here as well, the strain on the supply chain, the strain on working capital and the need for additional working capital, but also the increased risk in the environment out there. So maybe Canadian exporters are looking to export to different markets. Obviously, we've really continued to diversify as a country away from the U.S., and that's certainly not a bad thing. But the exporter needs to mitigate risk, and really, they can do that through various trade finance programs that National Bank has. So, folks, from my side of things, that was just a quick update on what we're seeing. So Blair, I will hand it over to you via Tom. Thank you very much for your attention, everybody.
Thanks, folks, for giving us the opportunity to address the group. And thanks, Chris, for those comments as well. I just wanted to take a few minutes to basically provide some overarching commentary around bank's experience both pre and post COVID with respect to companies and the extent to which they're having struggles with the whole issue of adequacy of working capital, and just talk to some of the experiences I've had with programs that are out there that were developed to assist with working capital issues and challenges through this COVID environment. And I'm not going to get into a huge amount of detail on these. I'm going to point them out to you. But if anybody listening wants extra inside information or detailing on any of these programs, then by all means, feel free to reach out to me. You'll have the contact information for us after the program. So just to start with, I think generally we have seen as a banking industry, we've seen working capital pressure, no doubt, across many sectors. And I think, as Ruben had pointed out to you, probably from what we've seen, the working capital pressure has been largely more concentrated in the service sector than necessarily in the manufacturing or primary production sector. I think that the whole issue of the supplier issue, longer duration in getting product. We've also obviously got net effect of having extended cash collection cycles that we're seeing, and certainly a genuine need to find a way to provide some type of higher amount of access to capital to support operations. In our experience to date through COVID, looking at our portfolio, and just generally speaking, I would have to say that the bank's probably been able to provide that type of working capital support just through the normal restructuring of the existing credit facilities that firms have. And in cases where we haven't been able to do that, then here's some of the ideas that are out there that you could consider looking at. And I think the natural one is for a company that is experiencing that extended collection time frame on receivables is to look at putting accounts receivable insurance in place, which obviously is a product that Tom's group brings to the table. Depending on your experience with advance rates against accounts receivable in the industry, they're anywhere from a low of 75% for anything that's invoiced up to 90 days. That's pretty much standard. You see some situations where you can get up to 80%, but the advantage of having accounts receivable insurance in place is the banking community will generally move that advance rate up to 90%. So that in itself, that delta between say 75 and 90 is significant in some companies when you look at the level of accounts receivable that they carry. That's the first thing I'd bring to your attention. There's other specific programs that have been out there that the banking industry has worked with in tandem as a partner with Export Development Canada, and I just outlined these for you on the chance you aren't aware of them. But one is basically the classic export guarantee program that is offered in partnership with EDC. And that program, there's a lot of different features of that program, a lot of different sub-programs inside it. But the one I'm particularly talking to here is the export guarantee payment program, where for a eligible company that has some level of export activity, you can actually partner with the bank to get a partial guarantee, so like a loss given default guarantee from EDC, and that allows the bank to advance a higher level of operating credit facility than what might otherwise be the situation for the bank without it. But classic export guarantee program is typically 50% maximum for a guarantee on operating line facility. And during COVID, there was a product brought out called TELP. You'll see there the second point, Trade Expansion Lending Program, is what it stands for. And up to a certain authorized credit facility amount for operating line, the firm can actually qualify for a guarantee of actually up to 75% of the authorized operating line. And that has had some huge advantages for us to support certain clients in the area where traditional lending guidelines would not have allowed us to participate at the level of support they needed without having that type of EDC partner support. So that's been a great program. We've seen it used a fair amount. And those first two are EDC specific partner sponsored programs. The third one on point there is what's called the BCAP program, or the Business Credit Availability Program. And that one's basically offered in partnership with EDC as well. There's criteria that are specific to that program, and mostly designed, specifically targeted at areas of support that's required to make loan payments, interest payments. You can use that program to pay down an existing operating credit limit. To the net effect of that is some of the money moves over onto a term facility, and you've got the access to additional margin room inside the operating facility limit that the business has. And then the last program that's out there it's called HASCAP, Highly Affected Sections Credit Availability Program. And that's a program that was brought out and tailored to partner with the Business Development Bank of Canada. And it's got, again, a fairly significant number of requirements to qualify for that program. And that's why it would be too extensive to get into it at this point in time for purpose of this presentation. But I'd be more than happy to discuss any of those programs with any of the listeners that are ever interested in looking at the possibility of how to go about and the steps needed to approach and get additional working capital financing. So I think I'm just looking at the time. I think that's as far as I'm going to go on that, Tom. I'll turn it back to you at this point, and we're certainly welcome any further approaches from people directly if they so choose. Thank you very much.
Okay, thank you, Blair. Thank you, Chris. And being conscious of time, I am going to get right into the trade credit risks and solutions. Receivables is one of the largest assets on the balance sheet, but it is one of the only assets that has potential for material loss that companies do not insure at this time. They do not insure for excessive write-offs in general. There's still low penetration in credit insurance. So to focus on some of these more specific trade credit risks related to post-COVID, first, it's liquidity concerns. What we've seen is that based on the COVID losses, we've had significant deterioration in balance sheets, higher leveraged. You have liquidity issues because these COVID subsidies are going away. There's higher inflation, as been pointed out by Ruben, which is going to result in higher interest rates, so higher costs for companies. And if companies want to grow, they need funds. They need funds to fund working capital, receivables, and inventory. And with deteriorated balance sheets, it's going to be challenging for many companies. There's also a need for much higher credit limits because of these bottlenecks and commodity price volatility that we've seen. In steel and lumber, we're seeing our customers ask for limits twice the size of what they have in the past. And with these higher limits and higher exposures means when a company defaults, it's going to be a larger bad debt. And one of the biggest challenges that we see is the zombie company defaults. Just to define what a zombie company is, a zombie company is a company that doesn't earn enough. I'll turn my video on. Doesn't earn enough funds to cover their interest expense, and they don't earn enough money so they can pay down their debt. They don't have the financial flexibility to deal with a market disruption, or to have the funds to fund growth. Morgan Stanley recently did a study that found that 1 in 6 companies met this zombie company criteria. Bloomberg did another study that found of the Russell 3000, 25% of the Russell 3000 largest companies in the US were zombie companies. And when you take this down to small, medium-sized companies, that percentage would likely increase significantly. So there's material risk there. And these companies are being affected. They were supported by the low interest rates and the COVID subsidies, and now with them going away, they're going to have some challenges. And you've also got the international recovery, fragile international recovery for emerging markets. That's going to affect the receivable risk and political risk of receivables in these foreign countries. Outside of all of these actual specific COVID risks, you have the issue in North America, especially of the uncertain customer risk, where there's limited financial disclosure of private companies, and there's a reliance on payment experience, which always doesn't give an indication. It helps if you're a major underwriter like Coface that's getting payment experience from multiple suppliers selling to the same company. You can see trends, so it can be helpful in that sense. But in terms of just a single customer single customer paying you, it's challenging to ensure that's predictive. And a recent survey by NFP found that 10% of companies, only 10% of companies get financials on their top buyers, and that only 25% of companies use bank reports as a routine check to determine the credit quality and liquidity of their customers. So there's the uncertainty of what the risk of the customer is. So you don't know, who is a good customer, who is a bad customer if you're just relying on payment experience. I thought to look at solutions, the best approach would be looking at a case study. So we're looking at a client of ours, which is a commodity distributor, and this could be, it could be an oil and gas company, a lumber company, a steel company. But this company had a high volume and a low 3 to 5% gross margin in their business. They're experiencing strong growth, so they needed funds. The buyers, they sell to a private with minimum financial disclosure, and they relied heavily on payment experience to establish limits and mitigate risk. And what they bought the credit insurance policy for was to increase their bank liquidity. And what they were able to do, along the lines of what Blair said, they were able to increase their receivable margin from 75%, and it was purely domestic credit risk, to 90% of the receivables. And that gave them $3 million more availability on their operating line. So that provided the funds that they needed to grow their business. It also strengthened that policyholder's balance sheet and creditworthiness. So if you're selling to that company and you say that they have much more availability on their operating line, you're going to know they have the liquidity and be less concerned about default. With that extra funds, they're able to invest in their business and improve their return on equity. But they bought it for that reason, but they still get it for all the other benefits of credit insurance when they buy the program. So they get the support of credit management. So when a credit program is put in place, the policyholder has a discretionary credit limit. So they make decisions on the smaller customers they have, maybe below 50,000 limits, and the ones above that, a limit is established with the underwriter. So in this case, the client had 82 buyers above the discretionary credit limit, and the underwriter was able to establish 42 limits on these buyers. And what we did, it was a lack of information on the other buyers. What we did as their broker is we actively pursued the financial information on the other 42 companies. We analyzed that information. We made recommendations to the underwriter. So we got the banking, we got the financial statements on these companies, and with that, the underwriter was able to establish almost all of the limits the customer required. And they were able to maximize their sales within these insured limits, knowing that they're going to get paid by the underwriter if the client could not pay them. So they got that additional support and almost the transparency to their customers, know which are good and which are bad. But in even though you have that transparency, you still don't know which ones might go bankrupt. And our customer had unexpected customer defaults in the first 2 years of their policy of $3.2 million of bad debts over 9 defaults. If they were uninsured, there was a high likelihood they could have went bankrupt. So they got all the other benefits of credit insurance that really helped their company survive. In terms of the cost of credit insurance, in most cases, it comes in between 0.1% to 0.3% of sales. And that's driven by your size of the company, the risk of your top 10 buyers, your historical credit losses. Those are usually the main factors. Often you can offset the net cost of the credit insurance because underwriters rate to a 50 to 60% loss ratio. The net cost of credit insurance would be half of those rates that I've quoted there. And with the increased sales you can do, with the maximizing sales with the comfort, you know that you're covered, you can pay for that net cost of credit insurance fairly quickly. With the application process, it's a short application, but what you will get is the underwriters looking at your top 10 buyers, and that'll give you insight on the credit quality of your top 10 buyers, whether you buy credit insurance or not. And NFP has additional information on their website. We have a publication, insight publication that will give you insights on all kinds of property and casualty risks, including trade credit, and you can visit there as well. Whether you buy credit insurance right now, and you need improvement on your coverage, or you need to understand whether you're paying a competitive price for your credit insurance, we can help in that situation. Or if you've never looked at it before, we can go to market, what we do is we always structure a policy that is customized to the client, understanding what their risks and strategies are to structure a program. We have access to over 18 markets across North America, including COFAS and EDC, which are two of our most important markets. What we our major strength is that we maximize coverage for our customers. That's what they're buying. They're buying coverage. We pursue the information, do the analysis to ensure that they have the coverage they require. So that's really the end of the presentation. We're fairly tight on time. We did have a couple of questions. I can pose them quickly. One question for Blair and Chris. We've had a number of requests for longer terms because of the time it takes now to ship product and container availability to the end customer. How's the bank going to look at a receivable up to 120 days or even longer, knowing that the customer has some challenges in this event?
That's a great question, and actually it kind of leads back to what Tom's been speaking about. Personally, I've got several accounts on my portfolio that have that same challenge, and we were able to take the advance rates out on these particular accounts all the way out to 180 days, because the credit insurance, the insurer in this case, was comfortable with the credit risk associated with that particular client that the business had. And we went back into our credit partners and got them to just modify the margining wording so that certain named clients could have terms all the way out to match the insurable terms that were offered by the insuring company. So that's what I would suggest that individual looks like, because it's quite capable of being put together.
Okay, thanks for that, Blair. That was a great answer, and I love the way you credit insurance was part of it. If we can just do one more question before we go, for Ruben. Ruben, the economy was quite strong prior to COVID. The question is were some of these disruptions going to happen anyways? Is this temporary, or are these higher prices here to stay? I know you don't have a crystal ball, but is there potential that these disruptions and it takes a while to bring on capacity in some of these resources, that the prices are increasing? Do you feel they're here to stay, or is there going to be somewhat of a ongoing increase?
Yeah, I think they're here to stay, because we will probably continue to feel this pressure on the supply chain in 2022. But with that being said, I think we should also expect that their demand will cool somehow when the extra cash that households had piled up as a result of the pandemic and not being able to spend last year of all the government support, all this extra cash, at some point is going to stay in savings. And so the growth in demand will slow a little bit. At the same time, we're seeing some higher investment in production capacity to respond to this higher demand. So although it will take time to come online, it will help eventually to respond. So in the short term, we'll continue to feel it, but my take would be that gradually and even in some sectors, we will see some of these tensions is a little bit in 2022 for a beginner. Then they will not disappear overnight, but even ease a little bit would already be an improvement.
Okay, well, thanks so much for that. Okay, I think that's the end of our presentation. Amber, do you want to close out here?
Yes, thank you. Thank you, everyone, for sharing your valuable time and expertise with us today. The recording and slide deck will be available within 2 business days. At this time, I'd like to take a moment to ask you to take a brief survey today. The survey will populate in a new window when you exit out of Zoom. Please take a moment to complete the survey as it lets us know what topics are important to our listeners and helps make our education program as current and relevant as possible. That concludes our webinar for today. Thank you everyone for joining us and have a great day.